management. In today's class, we shall continue with our lecture on valuation of a business. Uh, in our previous lecture, we talk about business valuation. We talk about how do we value a business, right? Why do you have to carry out a valuation of a business? Is because maybe you want to buy company shares. That is the reasons for valuation. Probably you want to dispose your subsidiary, right? Management buyout, right? So, or you want to for the purpose of tax purposes, right? Or it could be for merger and acquisition because you want to. The purpose is for you to get the current value of that particular business. Then you have to carry out a what? Evaluation of the what? Evaluation of the business. Now, and I said that there are different methods of valuation of a business: the asset-based method, the income-based approach, the dividend valuation, even the free cash flow is a method of valuation of a business. Economic value added is a method of valuation of a business, right? Merger and acquisition is also because when you want to say you want to do merger and acquisition, you want to determine the current value of the what of the business before you can be able to make decision, right? So, and first we mentioned asset-based method that under the asset-based method, under the asset-based method, there are three methods: the historical approach, the realizable, and the replacement cost. Now, and I said that none of this method will give you the best method of valuation because historical is based on future cost, the previous cost, which does not take consideration of the current inflation, the current inflation cost. The realizable means liquidation. We don't want to do business again, right? Under the valuation of a surveyors will say, oh, it is called forced to sale because you are liquidating. Why do you want to liquidate? Probably you want to pay your debtors. You want to pay those who are owing you. You have to pay your debt holder. That is why. But by then, you may be forced to sell that particular asset. Even if they undervalue it, you have to sell it. All right. So replacement cost as well does not, none of this, and I mentioned the disadvantages of all these methods. They are historical. It does not give the actual value of the what of the assets of the business. And I said whether you want to use any of these three methods, if you want to determine the value, right? The formula is the market price equals to the total asset minus total liability divided by the what? The numbers of shares. Now that means you are calculating the market price, the price of that particular business. But if you want to determine the value, just multiply that market price times the numbers of shares. We give you the value of the what? We give you the value of the business. Just for instance, when they want to push, what is the name of this company? They actually listed it in the Nigeria exchange market, I think last year. I've forgotten this. The name of this company. Let's use Dangote Refinery, right? You will see they will tell you that okay, Dangote Refinery is now listed in the Nigeria stock exchange market. At what rate? At what price? At what market price? You will see it maybe 24 naira per share. That 24 naira per share is the market price. Then if you want to get the value of that business, you want to get the market value now as at that period, right? You look for in the NGS, look at the volume, the numbers of shares, the traded volumes. When you multiply it by the market price, you have the volume, you have the current value of the business, right? And that is what it means, class. Now, how will you determine the numbers of shares? The numbers of shares is your ordinary shares given to you in value divided by the nominal price, right? Then before we move to any of that method, any of the three methods you want to use, it is total asset minus the total liability divided by the what? Divided by the what? Divided by the numbers of shares. Any of the method, right? Now, income-based approach. Income-based approach is subjective. It makes use of accounting profits. It's subjective. That is the disadvantage of this method, of this approach. It makes use of accounting what? Profit. It does not make use of cash flow, right? It does not what make it is very difficult to value a business that is not listed, like a private company, because how will you calculate the what the market price when it is not listed in the Nigerian Stock Exchange market class? So in this case, I can tell you that, oh, excuse me, price earning ratio, right? So the price earning ratio is equals to the market price divided by earning per shares. Then you make the market price the subject of the formula. The market price equals to price earning ratio times earnings per shares. I equally state something in our previous lecture that the price earning ratio, you may given, maybe you have a financials of 2024. You may be given the price earning ratio of 2024, 2023, 2022, 2021, and 2020 price earning ratio in percentage. What you need to do is that look for the average class, everything together, divided by the numbers of the price earning ratio. You have the what average ratio. Then you multiply it by the what the earnings per shares. The earnings per shares is for that year, right? The earnings what per shares, right? So and that is how you need to do it. So how will you determine the earnings per shares? Earnings per shares is calculated as the profit after tax minus preference dividend divided by the numbers of shares. You have that, right? So when you get it, you multiply. So another method is what? Earnings yield. And earnings yield is calculated as what? Earnings per shares. Earnings per yield means market price. So you still make market price the subject of the formula. Don't forget, the market price that you want to make the subject of the formula is market price per shares. If you want to get the value, you say market price per share times the numbers of shares. We give you the current value, the value, right? Using the what? The earnings, what? Earnings yield, right? Then the dividend yield equals to dividend per shares. Now, if you want to determine the dividend per shares, it is the total value of the dividend, right? For instance, Jitco may say, oh, we want to pay an interim dividend of 20, no, financial year, let's say the total dividend paid is 30 kobo, right? 30 kobo times the numbers of shares, 30 times the numbers of shares, we give you the value of the dividend that was paid out, right? Now, you just say, okay, excuse me. So the total value divided by the numbers of shares, right? We give you what? The dividend what? The dividend per shares divided by the market price. So still make use of the subject of the formula. These are called investment ratio, right? Under the financial ratio analysis, right? So, excuse me. So the market price equals to the dividend per shares divided by the what? The dividend yield. So you still make the market price. So the main objective of all is to determine the market price, the current value, the value of the business. And using that, you use the what? Market price. You need to get the market price. When you get the market price, you multiply it by the numbers of shares that they have. You have the what? The value of the business using the income-based approach. Please don't forget the disadvantage of using income-based approach. Now, another method here is dividend valuation. Now, you can only use dividend valuation for companies that pay dividend. Imagine Facebook. Before now, you imagine Facebook did not pay dividend, right? To its what? To its shares. Don't forget, you can get the returns through the market price or through the market price or through the dividend. So a company that does not pay dividend will not use dividend valuation method. You can't use dividend like now. I want to take over A, right? Sorry for using merger and acquisition, but I just have to use it. You want to acquire A. When you want to acquire A, and A is not paying dividend, now, what price will you quote for that particular business? All right? What price will you quote for that particular business? If it is not paying dividend, so you don't need to use dividend valuation. Even in real life, you don't use use the dividend valuation method. If the company is not paying what? Dividend. But in ICANN will tell you, okay, using dividend valuation method, right? Do this, do that. Now, don't forget, under the cost of capital, there is dividend with growth, without growth, and the dividend with growth. Now, the dividend without growth, right, is cost of equity under the cost of equity, right? equals to current dividend divided by market price. So you still make the market price the subject of the formula. You have the market price equals to what? The current dividend divided by the what? The cost of what? The cost of equity. That is the market price. So when the dividend is what? Is not constant. Is constant, right? Without what? Growth. Now, when there is a growth in dividend, right? With growth, dividend with growth. Although this dividend with growth formulas varies, right? Sometimes, if there is a growth in dividend, this may not actually work out in the question. This may not actually work out, but we'll get there. So dividend with growth, you can see the way you use to determine the dividend with growth. Can you see it? The current dividend 1 plus the growth rate divided by the cost of equity minus what? Minus the growth rate. This will give you the what? The market price. But guess what? It doesn't work like this, right? It doesn't work like this in a question. There's a way it comes. Don't forget, just like the way we did the free cash flow, when they said the free cash flow to equity, there will be a growth in that free cash flow to equity from year 5 by 5%, right? We grow it each of the year. So the same thing will be applicable to dividend. You may be given dividend that, oh, there will be a growth in dividend, 5%. Then 10% thereafter. You can see that the formula will change, right? So we'll get there. Then another method of valuation is free cash flow. Of course, why do you want to prepare a cash flow? It is because it is free. We've explained this in our previous lecture. Free cash flow to the firm, free cash flow to equity. I think in our previous lecture, we were able to examine free cash flow to equity. We did not talk free cash flow to the firm. It is still the same thing. The only difference is that when it is free cash flow to the firm, you add interest. You have to add back interest, right? You have to add back what? Interest. Then you use weighted average cost of capital to discount. Just take the format, right? And see. But then we'll still do more free cash flow to the firm when we get to what? Merger and acquisition. Now, other methods, right? Which I can't don't examine, right? But just have it at the back of your mind. Enterprise value. When you want to determine the total value of a business, you can use an enterprise value, right? It's the way we do it when you are doing a valuation of a business, even in real life, right? The market capitalization plus the total debt minus the minority interest plus the preference dividend minus cash, right? Minus cash, you have the value of the business. So we have EBITDA multiplier as well, right? So this most times it is not even applicable in ICANN exam, but just have it that okay, when you have to use enterprise value, this is how you will use to actually determine the what is it called, the enterprise value. If you don't have minority interest is those people who their shares are just the value of their shares are low, right, compared to what the majority interest. If you don't have it, just keep it and move on, right? So market capitalization of equity. Don't forget what is market capitalization, class. Market capitalization is you go to the NGS. I don't want to share my screen to go back to all those practical parts, but then you go to the NGS. You said the market price. Let's say the market price is 5 naira per shares. So when you multiply by the numbers of shares traded, we give you the market capitalization, and that is what it means of equity. That is the market value. So plus the total debt, right? Both your liability and both current liability and non-current liability are your debt. The minority interest plus the preference minus what? Minus cash. Of course, when you want to take over a business, why will you involve cash? You don't. When you want to buy over the business, will you buy over my bank account? Chimobi, you want to take over next gen now. Will you take over my cash that is in my bank account? No. That is why you have to remove that what? So under the enterprise value, under the what? Enterprise what? Value. So in this case, I think I'm done with the explanation of valuation of a business. The most important thing is for you to understand the formulas, right, given to us. You need to do what? Understand the formulas. Once you understand the formulas, everything is to determine the market price. because you want to use it to make a decision whether you want to buy the shares. You want to know if it is give you high market price or not, and that is what we want to do under the valuation of what? Under the valuation of a business, right? So let's quickly look at this question. This question is I have this question. So this question is adopted from ACCA as well as ICANN. So I think we need to move ahead. Okay, Benjamin.
Good afternoon, sir. Good afternoon, colleagues. Please, my question is on when there is growth rate under this dividend valuation model based on this formula. I want to understand how this formula is. Is it that this GO into 1 plus G will first of all divide it by the market price, and whatever we get will add our growth rate to it, or that plus G forms part of the numerator? I don't know if you get the question.
Yeah, no, no, plus G. No, no, okay, you want to understand that, okay, okay, I'm supposed to separate it. I'm supposed to separate it. It's supposed to be like this, sorry. It's supposed to be like this. Do you understand now? Do you
Yes, yes,
understand now?
it's fine now.
So it's supposed
So
to
after
be,
dividing everything, whatever we get, we now add our growth rate to it.
yes, thank you.
All right, sir. Thank you.
Yeah, you're welcome. So don't forget that I told you that this method is not like that, but there's a way, just like I explained earlier, right? So when we get to that part, we'll see what we can do on that. So class, are we good to go? Class, are we good?
Yes, sir.
Oh, okay, that's fine. Okay, let's quickly look at this question. I still have EMH, efficient market hypothesis. That one is written. You can read that one on your own. I think that was the diet I qualified, right? So when I the three questions, like I said, I think about 3 to 4 questions I've done before. I've done it several times. I just saw it live. I saw it live. 3 to 4 questions. I was like, okay. The last question was on EMH, which is what? Enterprise what? Efficiency market hypothesis, right? Why we when we come outside, like the students were like some professionals were like, oh, what is EMH again? EMH. What is EMH? They've not read. It is under valuation of a business, so that is why I decided to bring it. Should in case you come across EMH. EMH is efficient market hypothesis, right? It is for information. When I send the material, so please read through it. It's very important as well. So let's quickly look at illustration. This is KK Limited. Yes, this was a this was compulsory question. Um, this should be on Tuesday or Wednesday. Let's take this. Let's take this question. Okay. Person should unmute his mic. Who is that?
Hello, Ibro. Good afternoon.
Hey, ah, you call me Ibu. That means that person. Uh, okay, continue. Yeah. Good
Ibro,
afternoon.
please, I wanted to ask, this material you're talking about, I don't think I've seen it on the group chat. How do we go about the material?
Oh, okay.
Oh, yeah, welcome.
Abi. So I because when you say Igbo, I was like, who is this person? It's fine. So no, the material is for sale, 2000 L.
Okay,
Okay.
okay. Where? How do we get it?
Don't worry, maybe immediately after this class, we'll talk about it. You can just
Okay,
send, yes, I'll send you the account details, then you send the 2000. I'll share the material with you.
okay, no problem. Thank you.
Yeah, you're welcome. Okay, um, so just trying to. Okay, I think we need to look at this question. I'm coming. Let me check the required. Okay, yes. So this is another compulsory question, right? This is 30 marks question. Oh, yes. Okay, let's start from here. Let's start from here quickly. So you know our tradition is to read the required. We need to understand the required first before you start before you say you want to solve. Please, it is very important for you to understand the required. So once you understand the required, it is assumed that you have already solved more than 50% of the words of that question, please. Now, the first requirement, okay, prepare a report that gives an estimate of Zinco using. Now they say we should prepare a report. Don't forget that you assume that you are the, let's say you are the consultant to the firm. Probably they want to merge or they want to do anything. You want to determine the value of the business. But then they say we should just do reports. So we'll do our normal reports based on the asset-based valuation. You know, they just mentioned asset-based valuation. And under asset-based valuation, we have the historical approach. Is that also? We have the realization approach, right? Then we have what? Replacement cost. We don't know which of the two, which of the three methods we are using. But the question, when you read the question, you look at the additional information given to you, you will see, you will know that maybe you are using either the historical, replacement, or liquidation method. Then PE ratio, right? We need to estimate, prepare a report like this. So we need to determine the value using what? The PE ratio, right? Our report should contain that. This is what? 6 marks, right? 6 marks. So another thing is that dividend-based valuation. So we need to use, uh, to also use so we want to determine, well, don't forget, in valuation of a business, what you want to determine is value, is current value. Either you say market price or the value. So we should also use the dividend-based valuation approach. That is what? 6 marks. So the last one, okay, we still have another one. The present value of expected future cash flow. Don't forget, when they say expected future cash flow, expected future cash flow could be either this free cash flow to the firm or the free cash flow to equity, right? Don't forget. So in the question, we'll look at it. What will be the expected future cash flow? Is it equity or to the firm? Next, discuss the potential accuracy of each of the methods used and recommend with reasons a value or range of values that PT might bid for Zinco. It means that PT want to bid. You can see. That's why I say valuation of a business is all about we want to buy, we want to sell. So PT now, you need to determine the value or the range that PT will bid for Zinco, right? PT will what? What will be the value? You will evaluate it based on what they have. Is that also? So you now submit the bid to what? To Zinco. Now state clearly any assumptions that you make. Don't forget, in strategic financial management, in finance, assumption is input is normal. Is normal. So when you want to do evaluation of a business, when you want to do financial modeling, you have inputs, right? So is assumption is normal. So you state any assumption there. So this is what 10 marks. Total is 30 marks, right? So Pemisire, any question? Okay. So let's quickly, we are starting with asset base, but before that, let's quickly read the the question. Through, 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 through. Okay. Sorry, I will send the material immediately after the class, please. Parliament Temidayo, right? Parliament Temidayo, coming. Please, can you see my screen? Confirm.
Yes, we can.
Okay, okay. That's fine. Coming. Okay. Parliament Temidayo, which is PT, is a large engineering company listed on the stock market. Listed on the what? On the stock market. listed on the stock market. The company is considering the purchase of Zinco. Can you see it? There is a company now, which is PT. Is now considering that, okay, they want to buy over Zinco, and unlisted company. That is, this Zinco company is not listed, right, in the stock market. An unlisted company that produces a number of engineering components. So which means that if PT now want to buy over Zinco, so what do you want to determine? What do you want to achieve? Right? Now, you will determine the value based on the value of Zinco, right? And that is the purpose of valuation of a business. Either you say it is merger and acquisition, either you want to buy shares, either you want to dispose, either you want to do a lot of things under that disposal, right? And that is why you have to do what? You have to do a valuation of a business, right? Now, the board of director is concerned about the appropriate price to pay for Zinco. Of course, you don't want to go and buy. Company A cannot just give you value that this is the value for our company and you just go for it like that. No, you have to carry out a valuation, right, to see how much does the company worth, what is the worth of the business, right? Now, as a starting point, it has been decided to provide a range of valuation based on different industry recognized techniques, right? So the summarized financial statements, you can see the summarized financial statement. This is the statement of profit or loss account. Can you see it? You see the sales revenue 2020, 2019, the operating profit before exceptional items. So it means that they have actually deduct cost of sales before they arrive at operating profit before exceptional items. Because that is, your sales minus cost of sales is your operating what? Operating profit, right? So they've considered cost of sales, which we don't know how they arrive at it, right? Now, exceptional items. Class, the question is, what is exceptional items? Because we need to analyze this, because we need it. We need to analyze this part. Exceptional items. The question is, what is exceptional items? Now, exceptional items are items that are one-off. That is, you can see that in 2019, exceptional items did not occur. Probably they carry out restructuring, right? It is not regular. It is not what? It is not regular, right? Now, and PT want to buy over this financial statement is for Zinco. This is a summarized statement of profit or loss for Zinco. Then PT that want to bid for Zinco now see the statement of profit or loss. Now, if PT, but one of the courses I took online was what is it called? Let me just give you this. Merger and acquisition. That is from JP Morgan, right? Merger and acquisition. Before a company can give you the statement of profit or loss account, you can check it online. I will drop the link. So it's free, right? Merger and acquisition. So before a company can give you their financials, it means that you have passed through some stage, because there is always a confidentiality, right? There's a stages for that, right? Now, what is exceptional items? Exceptional items are one-off, right? That does not occur regularly. Now, if you want to take over now, you will not consider these exceptional items when you want to calculate anything that you want to calculate. You will not consider what? Exceptional items. Do you know why? Because these exceptional items is one-off. Now, you are in 2020. It does not mean that in 2021, the exceptional item will occur. So why considering it when you are valuing a business? You don't consider exceptional item. You don't consider anything that has to do with one-off, because it only occur once. It does not occur what? Regularly. Anything that occur regularly, you can consider it, because it will form the basis of what? Valuation of a business. So when something is not occur regularly, so why do you consider it? You don't consider it. That's means that you will overvalue the company, because what occur for the business in 2020 may not occur in 2021. That is why exceptional items is always what? Exempted. We'll remove it, right? We'll remove it. Now, interest paid, net, profit before tax, the taxation. So you can see the dividend that was given, right? You can also see the what? The dividend paid. So this is the financials. Can you see the financials? The non-current assets, right? This is the non-current assets. What happened to this one? Okay, that's fine. So this is the non-current asset, right? Okay. Non-current assets and current assets, which is inventory. So you can see the current assets, right? Then equipment and liabilities. Can you see it? And so additional information relating to Zinco. This is the additional. So they give you the company financials, both the statement of profit or loss account, as well as the statement of financial position. Now, what are the additional information relating to Zinco? Right? These are the information the company will give you so that you can use to determine the value of the business. Then you present to them. So it's not left for the company to say, oh, we want to, which method, which basis did you use in valuing Zinco? So you present it that, okay, now the Zinco Limited will now say, okay, we will choose this. We will choose this method. We will choose this. Before then, Zinco Limited would have done their own due diligence as well. Probably have calculated they would have calculated the value of their own business. Then they want to see what you want to arrive at. Then compare. So if it is okay with them, they will accept the bid, right? They will accept the bid. If it is not okay, they will do what? They will reject what? The bid, right? So when we get to merger and acquisition, we'll talk more on that. Now, if the acquisition succeed, there will be revenue synergy. Of course, one of the reasons why you do acquisition is revenue synergy. There's what we call revenue synergy, cost synergy. Revenue synergy means that you will increase, because of competitive advantage, you will increase in revenue. That is why you want to add another business. The cost synergy, because you want to reduce the cost. That is why you want to do what? Acquisition. We'll get there. Now, if the acquisition succeeds, there will be revenue synergy leading to increased annual sales revenue of Zinco of 25% for 3 years. Class, for 3 what? For 3 years. Don't forget, the information given to you in the financials was for 2019, 2020. So they are talking about 3 years now. If they acquire Zinco, the revenue given to us will increase 25%. Annual sales revenue of Zinco of 25% for 3 years, right? Now, and 10% per year thereafter. Don't forget, if they say something is 10% thereafter, that is infinity. You don't know, 10% per year to infinity. Now, non-cash expenses. What are the non-cash expenses? Including depreciation, were 4,110,000 in 2020. Don't forget, the financial given to you is 2019 and 2020. Now they are telling you that the non-cash cash expenses, so the including depreciation, the depreciation were the 4,100,000 in 2020. They have depreciation. Income tax is 30%, which means that their tax is 30%. Let me quickly check the financials if we have depreciation in the financials, which is under the profit or loss. Okay, but we are told that they have in 2020 the depreciation of that figure. Okay, that's fine. Oh, okay. Now, capital expenditure.
Sorry, sir. It's 3 minutes time.
Oh, that's fine. I've forgotten. Okay, thank you so much. So I think 5 million in 2020, and is expected to grow approximately the same rate as revenue. Class, let me quickly take Roman figure 1 again. If the acquisition succeed, there will be revenue synergy leading to increased annual sales revenue of Zinco of 25% for 3 years, which means the sales revenue will increase for 3 years. Don't forget, we are given 2019, 2020. So which means that for 3 years, we start from the 2021, 2022, and 2023. Now, in this capital expenditure, you are given that the capital expenditure was 5 million in 2020. Is that not so? So, and it's expected to grow at approximately the same rate as what revenue. And we're told that revenue will grow by 25% per year. Revenue will grow by what? 25% per year. So which means that the capital expenditure too will grow by 25% for 3 years. What are the 3 years? Don't forget, the financial given to you is 2019, 2020. So the 3 years now will now be 2021, 2022, and 2023. Working capital, interest payments, and non-cash expenses are expected to increase at the same rate as revenue. Working capital, interest payments, and non-cash expenses are expected to increase at the same rate of revenue. So which means that the working capital will increase at the same rate of revenue of 25% for the 3 years. If the interest payment, which is the interest, will increase at 25% per year for the 3 years, then the non-cash expenses, which is depreciation, don't forget, depreciation given to us, non-cash expenses include depreciation of 4,100,000 in 2020 is 4,100,000. So that 4,100,000 will increase with the same rate of what? Revenue, which means that the revenue is what? 25%, right? Now, Zinco has a patent with current market value of 50 million. This has not been included in the non-current assets. So which means that in the non-current asset given to us, under the financial statement, there is no patent, which is an intangible asset, right? It's an intangible asset. It has not been added. It has not been considered in the what? As what? As non-current assets. We need to consider it. Operating profit is expected to be approximately 8% of revenue. Class, when you want to get your operating profit, class, let me quick, okay, I'm coming. Operating profit is expected to be approximately 8% of revenue in 2021 and to remain at the same percentage in what? In future years, which means that in 2021, it will be your operating profit. When you want to get operating profits, it will be 8% of the revenue in 2021. You will now still do 8% of the revenue in 2022 because they say and to remain at the same percentage. 8% of the revenue in 2021 will give you operating profit. 8% of revenue in 2022 will give you operating profit. 8% in 2023 will give you what? Operating what? Operating profit. Now, dividend. Dividend are expected to grow. There will be a growth rate in dividend at the same rate as revenue. Class, dividend are expected to grow at the same rate of revenue. Don't forget, the revenue will increase by 25% and I think 5% thereafter. Let's check. 10% thereafter. Class, can you see it? You can screenshot. Immediately after this class, I will send the material, please. Right? 25% for 3 years, 10% per year thereafter. Now, and we're told that the dividend, what will happen to the dividend? The dividend are expected to grow at the same rate as the revenue. My screen is not showing. Is your network, please? Please, others, confirm if you can see my screen.
Yes, we can.
Okay, it's your network. Please. Thank you, Mr. Olawale. So you can see that the dividend are expected to grow at the same rate as revenue. So which means that the dividend will grow by 25% for 3 years and 10% thereafter. That is what it means. because the dividend are expected to grow at the same rate of revenue. The revenue will grow 25% for 3 years and 10% thereafter. The realizable value of inventory is expected to be 70% of its book value, which means that what they will realize in selling the inventory, it will be 70% of the book value. Class, what is the book value? The book value is the value given to you in the statement of financial position. So what they will realize in selling that particular inventory is 70%, right? Is 70 what percent? 70% of the book value. Next, the estimated cost of equity is 12%. The estimated cost of equity is what? Is 12%. The average PE ratio of listed companies of similar size of Zinco is 30 ratio what? 30 to 1. That is 30 over 1. That is 30 ratio 1. It's 30 over 1. Right? That is the average. Average earning growth in the industry. Average what? Earnings growth, right? In the industry is what? 6%. That is like an earnings per shares in the industry will increase by what? 6% per year. And what is the required? The first required is to use asset-based valuation approach to determine the what is it called? The value that PT will pay for Zenco, right? Asset-based valuation. Now, in this question now, which of these approach are we using under the asset base? Because it wasn't mentioned that it is historical, it is this, it is that. Which of these methods are we using now? In this case, class, which of the methods are we using now? Because it wasn't mentioned that either historical or this. Class, which of the method are we using? Since it was not mentioned.
So realizable value.
Realization.
Yes, you're supposed to use realization because the only figure they just adjusted for only the they just adjusted for only the what is it called? Only the inventory. All other costs still remain at what? All other costs still remain at what? All other costs still remain as historical costs. So we can use historical costs, then we'll bring in, thank you. We can use historical costs, then we'll bring in the adjustments of the inventory. So because why they bring in the inventory is because what it is being expected that they will sell the inventory is 70% of the book value. So we'll have to do what? We'll have to do some adjustment as well. So you can assume that you are using an historical approach. But however, you need to also consider also consider the adjustments of the inventory since it wasn't mentioned. Because ideally, if you say it is realizable, they're supposed to give you the realizable. They only give you realizable for what is it called? Inventory. They're supposed to give you, okay, what we realize for the asset of this and that, right? Maybe in our next question, you will see how it is being structured. So we're report, right? So we'll be doing everything in the report, right? Put our calculations and everything. We're told to do a report on that. We're told to do reports on that. We're told to do a report. I'm coming. So please pay attention. This part is very important. Valuation of a business is very important. You check past question, you see valuation, 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 valuation. So that is why it's very important, please. So suggested solution. Suggested solution. So if you want to write a report, they just say we should write a report, right? So the first thing you need to do is to do your introduction of your report. You know, ideally you're supposed to say, okay, the address, don't forget, ideally you're supposed to say, okay, if you want to do a report, they're supposed to say, oh, you are the consultant of PT. You are the consultant of PT. Oh yeah, do a report based on the basis of valuation to PT. They employ you as a consultant. What happened again? They employ you as a consultant. Then you need to do. Please confirm if you can see my screen. I don't know why it's happening. Okay. So they may employ you as a consultant now. So if you have to do a report, thank you. If you have to do a report um what is it called? To PT to get the value of Zinco, it is an external report. Is that also? It is an external report. So no, they don't say you should do a report. So what you need to do is that I don't understand. I've explained that now. So so if you want to do a report here, right? If you want to do a report here, right? So the best thing is for you to just do your introduction. Just say introduction, introduce what you want to do. Then you now start it. Asset-based what? Asset-based approach or asset-based valuation. You explain the asset-based valuation, then you do the calculation inside. Then you mentioned that, okay, this is what it is. And that is what we'll do now shortly, right? Asset-based, asset-based. There's no method you want to use or what is it called under the asset-based value that they will not give you your mark, right? The most important thing is that make sure you adjust for the inventory, move on. Just adjust for the inventory, add the historical, and move on with that. Any other method you want to use is still your total asset minus your total liability. Is that also? So that is it. So introduction. So let's quickly do introduction of our report. You can do introduction because so don't forget I said in case the question come in form of consultant, right? You have to do it based on an external report. You say you put your date, then you say okay, let me structure it. So I didn't mean you are a consultant now, right? You should have said, oh, the date after that to the person you are writing to, right? Then the subject valuation. You would have said it is valuation. Um, okay, valuation. You can say valuation of Zinco, Zinco PLC. You say valuation of Zinco PLC, valuation of Zinco PLC, or you can say, or you can do this. You can use another method. This is um to the board of so the address of the company that say you should do the valuation, right? Or the address of Zinco, you can put it, right? Then when it is to the address, then after that, put your DS, then you can now say valuation of inventory, valuation of Zinco. So you can put this as valuation of inventory, right? Or you can put it like this. Then you say you do your introduction. That is if you are the consultant, right? So in this case now, they just say do a report. They just say do a report. So you can just do your introduction. You can remove this and just start with introduction. Introduce your reports, what you want to do. Class, are we still together? Are we still together? Are we still together, class?
Yeah,
Yes,
with
sir.
you.
Okay, that's fine. So let's quickly do quickly. So so you can this report represents the valuation of Zinco Limited Limited using assets based P ratio and dividend valuation and present future cash flow for for the three 3 years under the review. This equals to the report also contains recommendations the report also contains recommendations on the basis of valuation. So this is what you want to do, right? So you have to introduce it. Class, are we still together? Who is against me here? If you are against me, let me know. Who is against me?
We are together.
We gather there. So introduction simply means you have to introduce what you want to do, right? In some cases, even some people they'll just come with their introduction. That is not what we do at Next Gen. What is the introduction? Introduction means what you want to do. You say this report represents the valuation of Zinco Limited using asset base, PE ratio, dividend valuation, present value of future cash flow for the 3 years under review. You can say, however, the report also contains recommendation on the basis of valuation. Full stop. And that is the introduction. Another person can tell you that, oh, let me use another form of introduction. Fine. You are good. Introduction is what? Is introduction. So, having done that for the cash flow for the 3 years under review. So, after this, what next? The next is to start with 1, asset base. Asset what? Asset based. Asset based valuation. Okay. This is a method of valuation which consider the historical cost of an historical costs of an asset as well as this. You can use your own English as liquidation and as well as liquidation and replacement cost. I'm just explaining. Right? So are we still together? We've not done anything, no. We just started, right? So if you did not understand, let me know. If you don't understand, let me know. Now, what is the formula? Class. The formula is when you want to get the market price, I will write the formula, but I will remove it from the intro. I will remove it from my report. It's not supposed to. You are not supposed to put the formula inside the report. So market price is equals to total assets minus total liabilities divided by the numbers of shares. Don't forget, total asset minus total liability numbers of shares. We give you net assets, right? So we pick it one after the other. I'm not supposed to put total assets. So I'm not supposed to put the formula here, please. I'm just doing it for the purpose of this class, but I will remove it. Yes, when we are done with what? With the report. Okay. Someone wants to come. Okay. So we'll pick it from total assets. We check if it is a million. Coming. Okay. Okay. So we move. So we pick it from total asset, right? Now, the question is, which year are you using? It is historical, class. It is historical. Now, when you cannot start from 2019. It is the current year, which is the 2020. You pick the cost for the year 2020, right? You pick the what? The cost for the year 2020. Now, I don't need to say intangible asset, this, that. Please, just give me figure. 27,150 plus 850 plus 17,000 for 2020. You can screenshot it so that you give me the figure. Rachel, are you seeing Esther? Okay. So let me scroll down in case we have any other assets. Okay, we have receivable. Okay. So the total is 59. The variable total it is just for 2020, right? 5930, 59030. So we can come down and say the total assets, I guess is a million. 59030. I guess it's a million, but I'll confirm that. So that is for the total asset, right? And don't forget, we have to make an adjustment. Okay, let me don't do it this way. Let's pick it one after the other. Oh, non-current, let me pick it from there. Non-current assets. Oh, shit, I have to. Okay, that's fine. Assets, non-current assets. Please add these two together. What do you have? You give me the figure, right? You give me the figure for this. 275,150. You add it together.
48,000.
Okay, I'm coming.
48,000.
Okay, 48,000. Okay, thank you.
28. No, 28.
Okay, that's fine. 28. 28. Sorry, we have to scroll up and down. Sorry. 28. That is non-current asset. So the current assets, we have the inventory, which we need to adjust, right? So we go back again. Sorry, I'm coming. My system is. I don't understand the explanation. As in now, We are picking total assets now. The total assets, we are picking total assets. We pick the first asset, which is this. Then the current asset as well. Then we need to adjust for the inventory given to us.
No, Ibro, I get that one. No. You said, no, I get what we are doing, but you said it's historical, right? So I was thinking we would have chosen 2019 instead of 2020.
No, 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 no. You choose the current year. It's historical. You choose the
Oh,
2019.
the 2020 is not the current year.
If the 2020, don't forget that they still have 2021, 2022, and 2023. Is that not so? Don't forget they still have 2020. They still have 2020. They have 2021, they have 2022, and they have 2023. Okay, I get. Wow. It is like a trap. You have to consider it. And again, even the non-current asset self is not even complete. And don't forget that we were told that Zinco has a patent with current market value of 50 million. Can you see it? Zinco has a what? A patent with a current market value of what? Of 50 million. This has not been included in the non-current asset. So we need to include the 50 million, which is the 50,000. Class, are we still together? So in our what? In our non-current assets, right? So I guess this is a million, right? So we'll just put it in million. I guess it's a million. Uh, okay. So if that is established, we need to continue with lecture. I'm coming. So patent, right? 50 million. Can you see it? So anyone who's done this will just additional information. We are done with this. The next one is 70% of the book value. We'll still do it now. We'll do that one. Okay, 70% of the book value. So we need to add 50 million to this. So let's say this in million. Just say it should be, let's say okay. So we need to add the 50 million to it, which is 50,000. So 50,000 plus 28,000 for the non-current assets. So this is 58. Class, are we still together?
78.
Okay, that is Kai. 78. Thank you. So the next thing is okay. So the next is our inventory, right? And don't forget that 70%. So that's replacement given to you. It is not for fancy that it is just there forever. So you can see that it has it unless if oh they give you other assets that are replacement, that is when you cannot use it everything. But you can see in this now, it is just the inventory. So you have to add that touch of replacement cost, and that is why it is not even a a basis of valuation of what of a business. It's not good, right? So we need to go back quickly. So someone should help us to screenshot this part. Screenshot. Okay, inventory is 17,000. Inventory is 17 what? Inventory is 17,000. So we quickly go back and inventory is 17,000. Then please screenshot this. You have receivable and cash and bank. Is that not so? Please, so that you give me the figure. Okay. So inventory is 17,000. So what is the figure? 17%. What do you have?
11,900.
Okay, 11,900. 11,900. Then, which other asset do we have? After inventory, we have receivable, right? Receivable. So what is the receivable?
13,790.
13,780.
90.
So what is 90? Okay, 90. So cash. What is the cash given to us?
240.
240. So what is the total assets?
14,000.
103,930. 930.
103,930, right? Is this correct?
Yes.
Okay.
Correct.
Okay, thank you. So the next one is total liability. The total liabilities, right? So we need to check. We need to go back. Total liabilities. Uh, total liabilities, right? So we have to scroll down. Sorry, we have to scroll up, and I don't know what happened to mine. So total liability. So this is current liability, right? So we did not have, I think the only current liability we have here is 27,600. No non-current liability, right? Class, there is no non-current liability here. Is that not so? Hello?
Yes, sir. No, no, correct.
Okay, okay. Please, I need to confirm if we are following, please. So this is 27,600. 27,600. 27,600. So current assets minus current liability. What do you have? What do you have?
76,330.
Okay, 76. 76 what?
330.
Okay. So net assets 70, sorry, 76
330.
330.
Sorry,
So
is it 27,700 or 27,600?
me, I don't know. Let me check. Uh
27,600.
okay, 27,600. Thank you. So net asset is total asset minus total liability. Please, if you don't understand, if you want me to explain again, I beg. See, valuation of a business is very important, right? Right? Valuation of a business is what? Is very important. So please, if you don't understand, just let me know. I don't understand this thing so that we look at it together. Please, you need to understand this thing. They say it is asset based. We're not told that they didn't even give us the basis for either the replacement, but then we're given the replacement of inventory. Is that not so? Then it means that your historical cost of your assets, that is that amount that you have is historical costs. Then it will have a touch of replacement. You have to add it. Yes, because that inventory of 70%, it is not for you to just ignore. Since they did not mention that use replacement, right? It is allowed. It's part of your assumption that you will state. Another student may not may not actually use that inventory and just use historical and move on. And when he wants to state its assumption, he will now state that okay, it is assumed that there is no other figure for there is no replacement or realizable value for other assets. So therefore, inventory did not form part of the historical cost. You move on. It is assumption, right? So another person will tell you that no, add it. It is not for fancy. Add it to it, right? Add it. In as much as you can argue your points, you are good to go. It's just like case study. There is no correct answer. He's not say you are correct. No, if you can argue your points, you are good. Now, this is the net asset, right? The next thing is, don't forget, the formula is, what is the formula? The formula is total asset minus your total liability divided by the numbers of shares. So we will now say, what is the numbers of shares? We'll go back to the financials. Number of shares. That is ordinary shares. We'll go back. Let's check from the financials. From the financials given to us. Okay, from this part. Can you see? Now, who can give me what is the ordinary shares? How will I calculate my ordinary shares here now?
I think
Class.
50 kobo divided 20,000 divided by 50 kobo.
That's good. 20,000 divided by what? 50 kobo. So now, that is what we use to determine the ordinary shares. That's a very good one, right? So, the 20,000 naira divided by 50 kobo. So, we give you the numbers of shares. What is the numbers of shares?
40,000.
You say?
40,000.
40,000. So, therefore, what is the market price? We divide it. Net asset divided by the numbers of shares. What is the market price?
91 kobo.
1 naira,
91 kobo.
91 kobo. Can you see it? The value, if you want to value this business, you will quote, if you want to value this business, you will quote, what is it called? You will quote the value is 76,330. The value is 70 because if you multiply 1.91 per share times ordinary shares, which is 40, you have 76,330. Now, the value is 76,330. Now, the range, which is the market price per share, is 1 year. So you will say, okay, so you will now quote that, oh, if they are to go by this, they will they have to pay. The value is 76,330,000. Then the market price will be 1 naira 95 kobo per shares. Right? Class, are we still together? Are we good? Do you have anyone who did not understand this? If you do not understand, let me know. Benjamin, you just join us now.
Oga, I've been
You
with
just
us
join us.
before. I know I've been with us. Even when you left, I've been there. Sorry, I've been there. My hands was even up before
Okay.
the class ended that time.
Okay.
Yeah, I wanted asking a question back then.
Okay, quickly ask your question.
Okay, so my question is two. The first question is how will I put this question? Okay, so now we use the figures of 2020. Is it because the years we are to calculate is 2021, 2022, and 2023? That was why we use historical cost of 2022. Was that the reason why?
Benjamin, no. Benjamin, that is why I say you are
Yeah.
not in class. I've explained that. You are preparing an account. Let's quickly go to IS 16. IS 16 will be measured at cost or revaluation. You see, when they say cost, it's an historical cost. What is historical cost? It's the cost you use in buying that asset. 3 minutes. Yes. Yes. I just want to explain something. Thank you. Favor. What is historical cost? It's the cost you use in buying that asset. So it has anything to do with years. You are working with the current year, 2020. It has nothing, historical cost does not have anything to do with years. It's the cost, actual cost you use in buying that asset. Right? When you look at companies that carry out their cost under the cost method, the carrying amount you see there is cost, is based on the cost method. It is cost, it is historical cost. That is why when you see an audited financial statement, it will be mentioned that, oh, the asset is carried out on what? On the cost, on the what is measured as what? On the cost basis. So anything that has to do with historical does not have anything to do with years. You work with what? With the current year. So let me quickly create another link, please. Thank you. So now we've gotten, this is the value. Benjamin, Shay, is just one question you want to ask, right? Do you still have any other one?
Yeah, the second one I wanted to ask is like you've answered it somehow. I just wanted to ask that under this asset valuation, if a question is being set, how do we know if we are actually to use as
It will
any
be,
of those three methods?
it
Because
will be
this question
stated.
did not stated
Yeah, did not,
categorically.
yes, it will be stated. The question did not just state it, it will be stated. Thank you. So, so, in this case, so you need to write small notes now. Is that not so? Now, the value, because you are writing a report, right? Okay. The value of 76,330, the value of 76,330 with a market price of Naira 91 kobo per shares, not likely to be accurate, as it assumes the economic economic value of non-current assets is the same as book value. Which is very unlikely. Thank you. Okay. Now, we may not use this market price. That is another thing you should take note. Please, that is why I usually say you should pay attention, right? We may not do what? We may not use the market price. Do you know why? Because at the beginning of this lecture, at the beginning of this question, we were told that Zinco is not a listed company. Let me show you. So when a company is not a listed company, so how do you want to determine the market price? How do you want to include the market price? Interesting. Now, PT is a large engineering company listed on the stock market. The company is considering the purchase of Zinco, an unlisted company that produces a number of engineering. Unlisted. The company is not listed in the what? If you calculate the market price, there's no cause for alarm, right? There's no problem. Everything is fine. But then you should also know that this company you are valuing, it is not a listed what? It is not a listed company, right? You are valuing it. It is not what? It is not a listed what? It is not a listed company. So the market price may not to be useful, because it is not listed. You can't go to NGS and check for the company, right? But the most important thing is, what is the value? The value is the net asset, because we don't want to determine the market price because it is not listed. So if you use it this way, there's no cost, there's no problem about it. But you should know that, okay, the value is this, and this will not give an accurate, right? Because it assume the economic value of non-current assets is the same as the book value, which means that what this means is that it does not consider anything that has to do with the time value of money. The assets you buy 2 years ago is historical. What is the cost then? Right? Then you still be taking that cost forward. You'll be taking it forward. You'll be taking it forward under the cost method of the basis of measurement, right? In line with IAS 16. Now, it does not consider what will be the time value, because if you want to go buy the assets now, the value would have appreciated more than that. Let's say you buy it 5,000. It could have been maybe 10,000 naira by now. So it does not consider it based on the what? It's just the book value, which is very what? Unlikely. Class, are we still together, please? Hello, class. Are we still together, please?
Yes, sir.
Okay. So it is not. So I will remove this formula. I will just remove this formula here. I'll remove the formula. Okay. So we are done with asset base, right? We are done with what? Asset base. So with that, anyone that you have question for me before we move to the PE ratio, please? Benjamin.
Sir, they not tire with me, I beg, please. Do not get tired, please. Hello, sir. Can you hear
I'm
me?
with you.
Yeah.
Yes, I'm with you.
I said this calculation we did for asset base, is it proper for it to be included in the report, or it's better the calculation is done separate than its
I've
application
I've
now done
I've
in the
explained
report?
I've explained it at the beginning of this
Oh,
class.
sorry about that. My network was
I've explained
fluctuating
it.
at some point.
That is it. I've
Yeah.
explained it at the beginning of this class.
Okay.
There are two ways you can do it. Put it inside. How do you arrive at this figure? You can include it in your report, right? So that the examiner will be saying where you pick the figure. You talk about the value. Where did you pick? How did you arrive at the value? Instead of going to your working cycle, just put it in your report. Put it in your report and move on. Then if you still want to go and do it in appendix, then bring it in. Fine. Anyone that you want to do. So if this is established, right? If this is established, number two, any other question, please? So before we move ahead, okay? Number two, the second method is PE ratio. P price earning ratio, right? That is the next method, the price earnings ratio. Now, let's quickly go back from the requirement price earning ratio. Now, if you want to determine the market price using price earning ratio, what is our formula? If I want to determine market price, so market price is equals to what?
Market price all over earnings per share.
Okay, market price. No, I want to determine the market price. Market price equals to what? Just give me market
Okay.
price equals to what?
Net asset divided by number of shares.
You say
No.
under price earning? Ah,
That is EPS times PE ratio. What are they calling it?
earnings yield. EPS divided by earnings yield.
Okay.
It will be, it should be.
Interesting. Okay. Oh.
PE
ratio is equals to market price over.
Interesting.
PE ratio
Price.
is equal to market price
It's okay, please.
all
Price
over
earning
shares.
ratio. It's okay. Price earning ratio times earnings per shares. Price earning ratio times earnings per share. That is what I need. I don't need the formula for calculating price earning ratio. Price earning ratio, price earnings ratio times earnings per share. Right? So the question is, what's the formula? What's the formula for okay, price earning ratio? So we'll pick it one after the other. Okay, we need to introduce this one, right? Okay. Let's introduce this. Price coming. You need to introduce this. Okay. Price, I'm coming. Price earning ratio, or maybe after the calculation, we can bring it in. Let's do the calculation first. I'm coming. So price earning. So let's say price earning ratio. Is price earning ratio given to us? Definitely, it should be given to us in the question. Let's quickly go back and check
30 to 1.
Price earning ratio. Okay, can you see it? The average PE ratio of listed companies of similar size of Zinco is 30. That's 30:1. That is 30/1. Is that not so? Right? So it's only, they will give you the price earning ratio. If they didn't give you the price earning ratio, they may give you the price earning ratio for like 3 years. Right? The best thing for you to do is to get the average. And what is the average? Is for you to add the price earning ratio given to you for the years given to you, divide it by the numbers of years, right? We give you the what? The average. We do what? We give you the what? The average PE ratio, right? We give you the average PE ratio. But in this case, the average PE ratio is given to us, so we don't have much issue with that, right? So if the price earning ratio is given to us, price earning ratio, so is equals to 30:1 is given to us. So now the next thing we have to look for, we need to look for is the earnings per share. Is that not so? Is earning per shares. And what is the formula for calculating earnings per shares? Earnings per share is equals to profit after tax. I will remove it in my report. So I'm just writing it out so that you understand again. Profit after tax minus preference dividend if it is given, dividends, divided by the numbers of shares. So we need to look for profit after tax, right? Profit after tax. Now, ideally, we're supposed to bring in the profit after tax given to us in this question. We're supposed to do what? We're supposed to bring in the profit after tax given to us in this question. What is that, Rita?
Sir, please, can you check the question? While we were reading, you said that a particular figure is our EPS.
No, I didn't say a particular figure is your EPS. So what I mentioned is that it will not form part of your calculation. So you can, the EPS is not given in this question. What you are given is just the average PE ratio. Can you see the average PE ratio? Right? Can you see the average PE ratio? EPS will not be given. So EPS will be calculated from your profit or loss account.
Sir, sorry, what is the meaning of average earnings growth?
average earnings growth is equity now. They say, let me show you. Come. Average earnings growth is not equity. Oh. It's not your profit after tax. Oh. Later. Average earnings growth in the industry. They are telling you that in the industry will grow by 6% per year. That is the earnings of the industry, not the earnings of Zinco. The industry at which they operate. Do you get that? Do you get that?
Yes.
So let's quickly. So when you want to, you need to determine your profit after tax. So that your profit after tax will not be given to you. You have to determine your profit after tax. Now, ideally, we were supposed to use this. They made a loss. And what made them to make a loss is because there is an exceptional items, which is not our own business, right? Our own is to do what? We want to determine the profit after tax. We are supposed to pick this as a loss, right? But then we will not pick it. Do you know why? Because there is an exceptional items. When you are valuing a business, let me repeat this again. And there is one-off items. One-off items are items that do not occur regularly, right? Restructuring, right? Now, in that, it will not form part of the basis of your valuation. Do you know why? Because it does not occur in the business oftentimes. It is only when you feel like you have to do these things before you will see it. So when you are valuing a business and you see exceptional items, you remove it. So we need to remove exceptional items. We need to do what? We need to remove exceptional items from that so that we will need to recalculate the profit after tax. We need to remove it. It will not form part of your basis of the valuation, right? Now, in this case, we can just remove it this way. Okay. Let me copy this. I have to copy this. Upcoming. Okay. Come. Okay. So don't forget, when you want to value the business, it's based on the current to you, right? Unless when it is under free capital that you need to do that 3 years given to us. Now, in this case now, you have your revenue, operational expenses. So we need to remove the exceptional items, which is this. Okay. Now, when you remove the exceptional items, we don't need the dividend. We don't need the dividend paid. So when you remove the exceptional items, so we need to get what is your profit, the profit after tax. So operating profit before exceptional items minus 1,400 minus what do you have? What do you have here? 6,510 minus 1,400. What do you have? Hello?
5110.
What do you have?
5110.
5,110. Operating profit before the exceptional minus the interest, right? So the tax, when you minus the tax, what is your profit after tax?
4060.
So they make a profit, right? So what do you have? Is profit, right?
4060, yes.
Okay. 10, sorry.
4060.
4060. So if you have question before we move ahead again, you can ask your question now. So we've determined the profit after tax, right? We've already determined the profit after tax. What next? We need to, if there is preference dividend, in the question, we're just given the dividend. That is the dividend paid for the year. So you can assume to be your preference what? Your preference dividend, right? This is profits. Okay. So we already have the profit after tax. Then minus preference dividend is not given to us in the question. Then divided by the numbers of shares. The numbers of shares still remain the same, all right? The numbers of shares still remain what? Still remain the same. So we have to do that. So profit after tax divided by the what? The numbers of shares, right? Since the preference dividend is not given to us in this question, right? So therefore, earnings per share is equals to the profits after tax, which is 406. Don't forget it's a million, right? Let's include it. Divided by, what is the numbers of shares that we calculated before? What is the numbers of shares? 40,000, right?
Yes, 40,000.
40,000 shares. So what is our EPS when you divide it? Is it 40,000 or, okay, because that one, this is a million. It should be 40 million because I'm using this, but let me just remove this zero so that, so what do you have?
0.1015.
0.1015.
1015.
0 point what? 10 what?
15.
I can't hear
Zero
you. 0.10.
Zero point one zero
0.1015.
1.5.
0.1015. Okay, like this, 0.1015. So you can just leave it as this per shares, right? Per shares. So we've calculated our earning per shares. Don't forget, this is what we want to determine the market price, right? So we'll calculate the earnings per shares, and the PE ratio is given as 30:1. 30:1 is 30 divided by 1. That is what it means. Just say 30/1. That is what it means. It means 30/1. Now, the market price, the market price, the market price is equals to the PE ratio, which is 30 divided by 1 times earnings per shares. What is earning per shares? 0.01, 0.10 per shares. So what do we have? What is the market price?
3 naira.
3 naira per shares. So let's get the value. Let's just get the value. Market value. Just multiply it by the numbers of shares. Market value is equals to 3 naira per shares times, what is the numbers of shares? 40,000 shares. So what do we have?
120,000 shares.
That is 120,000 naira, 120 million. This is 120 million. Do you know why it's a million? Because the 40,000 shares is 40 million shares. Do we get that? Hello, class. Hello.
Hello. Hi. Hi, sir.
Yeah.
Okay. 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 So do you know why it's like that? Because we removed the 00. Is that not so? So it's supposed to be 40 million shares. So you can write 120 million, 120 million naira. That is the value. Okay, Olanike.
Thank you, sir. Good afternoon, sir.
Yep.
Please help
Yeah,
me
good
follow up a
afternoon.
little bit. I think I missed something in the adjusted that profit side. So
Okay. Okay. Class, are we good?
I still have a question. That's where I think
Okay, what is it?
that's aggression. I think
Yeah.
40% of the new
Thank you. Thank you.